In this presentation, we will begin the long process of learning about various characteristics and numerical measurements and certain attributes that we can ascribe to individual stocks and begin the process of what is often called fundamental analysis, examining, researching, and ultimately deciding whether or not we want to buy a stock, applying a valuation to the stock. And it will take several chapters, so get ready, buckle up. Slide 60. Let's take a look at some common stock characteristics. Now remember, these are common stocks, not common characteristics, but common stocks, which is the legal term for what we normally describe as a stock, a corporation. A spinoff, a stock spinoff. This is a conversion of one of a firm's subsidies to a standalone company by distribution of stock in that new company to existing shareholders. The company is divesting, that's the word they use, divesting a piece of itself. It's selling a piece of itself. Sometimes the new company is still majority owned by the company that spun it off. Kraft Foods, which is now Kraft Heinz, was spun off from Altria, which used to be Philip Morris, because many people just would not invest in Altria because they sell cigarettes, but they owned Kraft. They also owned Miller Brewing. They owned a lot of companies. They then divested themselves of the international tobacco business, and that's the company called Philip Morris International, which sells the Virginia Slims and the Marlboro cigarettes outside the United States, even though it's based inside the United States. You might have heard of Yum Brands. No, you probably haven't heard of Yum Brands, but you know who they are: Kentucky Fried Rat, Pizza Crap, and Taco Smell. No, Kentucky Fried Chicken, Pizza Hut, and Taco Smell. Anyway, Pepsi used to own those, and they spun them off. They sold them off, but they kept most of the stock. You're not stupid, right? The history of spin-offs have been checkered. Some spin-offs have done better than the companies that spun them off. The Baby Bells, most of you weren't around, but in 1984, the AT&T was broken up into AT&T and the 9 Baby Bells around the country. 2 of them, they started eating each other, and eventually 2 of them became the 2 companies that we know today as the new AT&T, which was SBC Communications, Southwestern Bell Communications, and Atlantic Bell, which became Verizon. And SBC got so big they bought the old AT&T just because they wanted the name. Some spin-offs have not fared so well. Coca-Cola Enterprises was spun off from Coca-Cola. Now, wait a minute, what's going on? Coca-Cola is the company that makes the syrup that you turn into the fizzy sugar water with a brown crayon dipped in it. Coca-Cola Enterprises was the bottling enterprise. It didn't do so well. And Lucent Technologies, which was spun off from old AT&T, almost went through bankruptcy. We'll come back to Lucent Technologies later on. They were examples of disappointment. So sometimes it's a good idea to buy the company as divested. Other times, not so good. A stock split is an accounting maneuver, and you hear quite a bit about these stock splits, but folks, it's nothing that is important. Well, maybe, it depends, but it's an accounting maneuver in which a company increases the number of shares outstanding by exchanging a specified number of shares of each stock for each outstanding share. Let me say that again. A maneuver in which a company increases the number of shares outstanding by exchanging a specified number of new shares of stock for each outstanding share. And the typical one is 2 for 1. You had 100 shares, you now have 200 shares. Yippee! Whoopee! Whoop! Big deal. The price went from $20 down to $10. You see, it's an accounting maneuver. There's no value created. They simply rearranged the capital structure. You had 100 shares at $20, now you have 200 shares at $10. It's worth the exact amount. There are 3 for 2 splits, 5 for 1 splits. There are reverse splits, 1 for 10. You had 10 shares and now you only have 1. The price goes up tenfold. They do that when they're in trouble of being delisted from the New York Stock Exchange or the NASDAQ because the price has gotten so low that they don't want to be associated with penny stocks. Look, read together. There is no increased value from stock splits. If you had 1 share at 20, now you have 2 shares at 10, the value is still $20. It's a psychological increase at best. In fact, when companies split the stock now, it's almost always as a way for them to say, hey, we think things are actually pretty darn good. We're going to split our shares. But there's a few other reasons, but no. It used to be this company split their shares so that it would be easy to buy 100 shares, right? You with me? Remember the round lot? But that's all gone now. It's not important. Warren Buffett of Berkshire Hathaway, we've discussed him. We'll discuss him later on. He always thought it was a bunch of hoo-ha. He didn't like it at all. And so from the 1960s, he's refused to split his stock, Berkshire Hathaway. A single share now goes for around $470,000 as of January 2022. And you think that's ridiculous. No, it's not. A single share of Coca-Cola or GE or ExxonMobil, if you had purchased them, when they started, would now be going for that kind of money. In fact, there was a great story in the chapter 3 section about a woman who, when she started working at Abbott Labs, it's a company you probably never heard of, but you probably used their products not knowing when they took some samples of your blood. She bought 3 shares when she started working there. And I forget what they were like. By the time she never sold them. By the time she passed away, 80 years later, whatever, 60 years later, they were worth $1.3 million, the 3 shares. So yeah, that's the kind of wealth, that's the kind of exponential growth that companies have created. Slide number 62, Treasury stock. What? Treasury? Nothing to do with the United States Treasury, folks. Once you as a company buy back your own shares, it's called a share buyback, a share repurchase. Those shares are put in the Treasury. They're essentially taken out of circulation. They're essentially destroyed. Share buybacks reduce the number of outstanding shares. Now, what's the logic behind this? The logic being that after you create a buyback, after you've gone out to the world and bought back your shares and put them in the Treasury, there's now a smaller supply. Existing shareholders now have a larger percentage ownership of the corporation. And if you've taken Econ 101, you know that if the supply is diminished and the demand stays the same, which of course everything's always changing, but if the supply is diminished, the demand stays the same, what should happen to the price? Right, the price should rise. During the run-up of the 1990s, share buybacks were often seen as a better alternative to dividend increases. The belief was that investors were more interested in capital gains than dividends, and that buybacks increased the potential for capital gains by reducing the supply of stock. The hallmark achievement of Agent Orange, the Trump administration was the 2017 Tax Cut Act, and the taxes were cut dramatically on corporations, and the idea was that it was going to create more wealth for workers. They're going to pay them more, and they're going to invest all that money. What did they do with it? Most of it went to share buybacks, which is a legitimate use of the money, but it wound up benefiting the very wealthy, which hopefully you're going to be one of them eventually. But yeah, and some companies, because of the incredibly low interest rates throughout the 2020s, were borrowing money to buy back their own shares. Ooh, I don't know if that's such a great idea. In my humble opinion, I like to reduce debt. My motto is make love, not loans. But these people were saying, what are you talking about? We can buy money at 1%. What are you worried about? What happens when you go back to pay the money, your earnings are down? Oh, well, That's the dual-edged sword of debt. Classes of common stock. What? Well, this has nothing to do with the classes that we talk class shares and mutual funds in chapter 2. No. Some companies will issue different classes of shares, some of which have different privileges and benefits. Often you'll see a Class B share that is not traded, or maybe it is traded, but the Class B share is for the family and they pays a higher dividend. Or some companies, Fleecebook, Meta, Facebook, created a separate class share that has much more voting rights. And this was done by the CEO so that he would never lose control of the company. A lot of people in the industry are not happy about these share classes that have more power than the commoners own, but that's the way it works. At one time, I think GM had 7, A through G or something like that. They don't have those anymore. The example that we love to talk about is the Berkshire Hathaway. Remember the shares for Berkshire Hathaway? You never split them, selling for $470,000 a piece. Those are the A shares. But in the mid-1990s, the financial world pressed Warren Buffett to offer a lower-cost version of his stock. He didn't want to do it. And they started threatening him with some accounting maneuvers that they were going to pull off that eventually got pulled off anyway. But so he said, all right, he created the Class B shares. And he sold them for $1,160 each. That's not, remember they wanted you to buy 100 shares. So he said, okay, I'll play your little game, but I'll make them $1,160 each. In the prospectus, I love this. The guy's honest. He said, I wouldn't buy these. If you want to buy my company, buy the A shares. If you don't have enough money to buy my A shares, then you shouldn't be buying my shares anyway. At the time, I think they were like $30,000, $40,000 a piece. But he found out that these B shares came in handy. He could use them like cash to buy other companies. So in 2010, they split 50 for 1. You had 1 share, you got 50 shares, lowered the price by a factor of 50, and they now sell for around $308, which is not atypical for stocks. And he uses them to buy other companies. He uses them like cash. Pretty interesting. So where are we? Slide number 64. Par value, book value, market value. Well, the par value is pretty meaningless, folks. It reminds me of the when you get a coupon on the back, it'll say it's worth 0.0001 cent. Sometimes 1 cent or 0.001 cent or something like that. It's meaningless. It's something to do with the way companies are brought to public, and I know nothing about this. Talk to a corporate lawyer or something like that. But the book value is fairly important because that tells you what the company is worth on the books. That's why it's called book value. You might remember this from your financial planning and money management class, principles of money management, or your accounting class as the net worth, as the equity. Assets minus liabilities equals net worth, equity. Well, in the investment world, we call it book value. It's how much one share would be worth if you sold off all the assets, paid off all the debts. Now, if you did indeed try to sell off all the assets, you might not get what the accountants say they're worth on the books, right? You might get more. You might not get as much as probably not get as much as what they say they're worth, but that's how it works. The one piece of information that everybody's interested in is the market value. This is what the stock is selling for in the open market every day. And that's set by the forces of supply and demand. And it is usually far higher than the book value, which is what you'd expect. I mean, think about a business. How much is a shoe store or a pizza shop worth if you were to sell all the assets? Not a whole lot, right? It's worth what it's worth because it's a going concern. That's the term the IRS uses. It's a business in business to make money, and so the assets are just what they have on the books, important, yes, but the fact that the company's in business making money, that's what gives it its value. So the market value will usually be 5 to 6 to 10 times more than the book value. We'll discuss more about valuation in Chapter 4. Oh boy, and Chapter 5 too. So we're going to discuss quite a bit about valuation. Okay, slide 65, dividends. Oh, I love dividends. Dividends are distributions of earnings given to stockholders. They're normally paid quarterly in the United States, and most companies that are based in countries that at one time or another in their past had something to do with the United Kingdom, England, Canada, South Africa, Australia, Hong Kong. These companies in those countries tend to pay their dividends quarterly, like the United States. Other countries, the companies tend to pay semi-annually or annually. The board of directors decides how much, if any, dividends should be paid and when to pay them. The dividends are usually a percentage of the earnings per share. Very important number that we will deal with. The amount of annual earnings available to common stockholders on a per share basis. So with this idea in mind, we can think of our one share of stock like a little business. Our one share of stock is earning 75 cents or $1 or 50 cents or whatever. And we can think of it like a little factory producing some earnings for us every year. And of course, if we have 100 shares, you multiply it by 100, right? And then out of those earnings per shares, we often get paid dividends, and dividends don't lie. So slide 66, here's an earnings per share example. The company reports net profit of $1 million. Well, that's a lot of money, but we have to look at it on a per share basis. There are 500,000 shares outstanding, so you take $1 million of earnings divided by 500,000. You can cross off all the zeros, and you get $2 of earnings per share. The board of directors might decide to pay out 50% of the earnings per share in the form of dividends. So they've earned $2, they're going to pay out 50%. That would be $1. So every share you own, you would get $1. That is money in your pocket. That number is true. All the other numbers that they produce, they might be fanciful, they might be true, they might be estimates. The dividends is the one number you know is exactly true because they sent you a check. Well, they don't send you a check anymore, folks. They do it electronically, but you got the idea. And that's called the dividend payout ratio. The company is paying out 50% of its earnings to shareholders in the form of dividends. Some companies pay out higher percentages, some companies pay out lower percentages. Larger companies that have been around for a long time and don't need the earnings to be reinvested back in the company tend to pay out more. Younger companies, growing companies tend to pay out less, and some don't pay out any dividends. Remember, dividends are optional. So this allows us to compute the dividend yield. This is a measure that relates dividends to the share price and puts stock dividends on a relative percentage basis rather than an absolute dollar basis. So if the stock in the previous slide that was paying us $1 dividend, we're selling for $20, that would be $1 of dividend divided by $20 price, or 5%, 0.05. Check it out, make sure I did it right, do the calculations right. This makes it easier to compare stocks with other income-oriented vehicles such as bonds or savings accounts. And as we said that traditionally 3, 4, 5, 6% was normal, but in the run-up of the 1980s and 90s, dividends went to 2% or less. They then went above 3% in 2008 and 9 because the price fell, because all you got to do is lower this number on the denominator to make the whole quotient go up. So you can raise the numerator, that makes the quotient higher, or you can diminish the denominator, and that makes this quotient go up. Either way. Dividends now are back down to below 2%, and that's why some people say stocks are way overpriced, but they've been under 2% for a long, long time, so we'll see. Important dates in stock dividends. Now, I know, this is stuff that doesn't really excite people, but it's important for you as rising investment gurus to know how this works. There's a declaration date. That's the date that the board of directors declares a dividend. Okay, we're going to pay 50 cents a share, $1 a share. And we're going to pay it on the date of record. We're going to pay it on June 17th or June 18th or whatever the date happens to be. So you must be a registered shareholder of the firm. You might have to own the stock to be entitled to the dividend. Now here's where it gets a little tricky. The ex-dividend date is 2 business days before the date of record. This actually is the date that you have to have purchased the stock to be an official shareholder. Why? We're going to see on the next slide why. You see, stocks, you buy a stock, you don't actually get it for 2 days, 2 business days. You sell a stock, you don't actually get your money for 2 business days. Mutual funds, open-end mutual funds, it's called the settlement date. You buy the mutual fund on Monday, you don't actually get it until Tuesday. And bonds are that way too. Bonds settle in 1 day. Stocks settle in 2 business days. So you have to be the owner of record 2 days. If you're already the owner, it doesn't matter. But if you want to buy the stock to get the dividend, you have to buy it 2 business days before the date of record. Does that make sense? I hope so. We'll see on the next slide how it works. The payment date is then a few weeks later. And a couple weeks later, the money comes into your account electronically. I used to send you a check. They don't do that anymore. So here's the example. Why is the ex-dividend date 2 days before the date of record? Because stock transactions close, settle, it means the same thing, in 2 days. If you purchase a stock on June 15th, you don't actually get the stock until June 17th. Actually, this is one thing, if you have a personal broker, you can say to your broker, hey, broker, I know I don't have the money, but I want to buy this stock today. And the broker, if they know you, they'll say, no problem, we'll take care of it. You buy it, you have 2 days to get the money in. You see, that's how many of the discount brokers won't let you do that. No. You have to have the money in your account before you buy this share, buy these shares. But a personal broker, they'll say, no problem, you come on in, we'll take the money. The same thing happens when you sell. You don't actually get the money for 2 days. So if you have a personal broker, a lot of times they'll say, don't worry, you need the money now, we'll give it to you, we'll spot you the money because you're not going to get it for 2 days. Like I don't know if Robinhood does this, but many of the deep discount brokers are just not going to do that. And this is what happens on the ex-dividend date. Theoretically, although it doesn't usually work that way, theoretically, the opening share price on the ex-dividend date should reflect a drop in price commensurate, you like that word, it means along with, the amount of the dividend. So in other words, if they had declared a $1 dividend, we should see the stock price reduced by $1 on the ex-dividend date because they're taking $1 out of the company and sending it to every shareholder. It doesn't work that way, folks. Prices are changing all the time. But theoretically, that's how it works. They're taking $1 out of the company, corporation, and sending it to the shareholders. So you will hear a saying on slide 70. Don't buy the dividend. This is for short-term traders and like. But you as rising investment gurus, you have to understand this. You have to be apprised of this saying that you might hear from people say. The translation is: look, you're often better waiting until the ex-dividend date before buying a stock. And here's the logic. Dividends are taxable transactions. If you buy the dividend, you buy the stock just before the ex-dividend date, you're going to have to pay the taxes on the dividend, and presumably the price will fall commensurate, there's that fancy word, with the amount of the dividend. So you're better off waiting until after the ex-dividend date so that you'll get the stock at a better price and not generate a taxable transaction. Folks, this is, not important. Unless, you're talking about a lot of money and all of a sudden you're going to get this huge tax bill, in which case, congratulations, I don't feel so sorry for you. At the brokerage firm I started working at, it wasn't my client, but there was a long-term client who would buy the dividend. That's what he lived for. He had a lot of money, folks. And he would buy a ton of shares right before the dividend, get the dividend, be the owner of record on the dividend, and then sell the shares. I wasn't quite sure I understood the logic behind this. What if the stock drops precipitously? It's short-term thinking, but that's what he wanted. He wanted those dividends. And so think about it. For most of us, it's not a big deal. We're not dealing with tens of hundreds, millions of dollars of money, so it doesn't really matter. But you're going to hear people say this: don't buy the dividend. Yeah. Now, slide 71. This stuff is important, folks. This one, I want you to memorize this slide big time, okay? Because there are two different types of dividends. There are cash dividends and stock dividends. And if you don't remember everything about this, what I want you to remember is you want cash dividends. Don't let anybody sell you these stock dividends because they're worthless. And how does this work? Well, if you get a cash dividend, which is what you want and which is what most bona fide, reputable companies are going to give you, you're getting payment in the form of cash, which means you have to pay taxes on it. Okay, well, just like if you get interest or rent or whatever, you have to pay taxes on it. Unless it's in a retirement account, then you pay taxes when you take the money out. Unless it's in a Roth, and then you don't pay taxes, which is very cool. But some companies pay their shareholders in the form of stock dividends. This is the payment of a dividend in the form of additional stock. But folks, they're just adding. Remember the stock split? It's kind of like a stock split. They're diluting the ownership. So they're going to create more shares. If you know Econ 101, if the supply goes up and the demand doesn't change, the price is going to fall, right? So the board of directors declares a 10% stock dividend. So you have 10 shares, you get an extra share. Yippee, you now have 11 shares. And the price dropped 10%. So did they really give you anything? No. And thankfully, the IRS says they didn't really give you anything, so we're not going to tax you. Thank you very much, IRS, for not taxing me on something that isn't worth anything. So if this kind of is a little tricky, you don't really understand it, just remember you want cash dividends. And with most large, well-established, prudent, long-term oriented stock investments, that's what you're going to get. Here's where it gets strange. On slide 72, there is the discussion of dividend reinvestment plans. I just love the name, DRIP. Do you want a DRIP? Yes, I love DRIPs. These are plans in which shareholders have cash dividends automatically reinvested into additional shares of the firm's common stock. Look, this is a taxable transaction. There's no additional shares. What did the company do? Well, actually, they don't do it. They contract with some company that does it for them. You buy 100 shares of whatever, and they are going to give you 50 cents a share, right? So you're going to get $50 worth. What they'll do is they'll go out on the open market and buy shares that are selling, whatever the price happens to be, and credit you with those additional shares. So it's kind of like a mutual fund in this way. In a mutual fund, they automatically will reinvest the dividends in additional shares. And this is what a dividend reinvestment program does. It used to be that most brokerage firms didn't really want to do these, so you had to go directly to the company, and then you might have 7 companies and you have 7 different statements. But now most brokerage firms say, yeah, we'll do the DRIP for you. DRIPs are an excellent way to own stock for those interested in long-term growth and not interested in current income. It allows the investor to take advantage of compounding automatically with normally or tiny little transaction costs. On the website, and in the face-to-face classes, we would go to the website and show you the DRIP for San Diego Gas and Electric, Sempra Energy, which is actually pretty cool. Every once in a while, they would charge us 3 cents. I thought, this isn't bad, 6 cents. So the company wants people to buy their shares, right? They want to be popular, so they're going to charge them, very minimal amount or nothing if they can get away with it. But it does cost them something to run these programs. So check out DRIPs, Dividend Reinvestment Plans. Cool. It's kind of like a mutual fund. The mutual fund does the same thing. It automatically reinvests when they give you a distribution, the cash dividends. Remember, there's still cash dividends. They're just turning around and buying shares for you automatically, and you have to pay taxes on that transaction. And so we'll end this presentation on the most widely watched stock statistic, and that is price to earnings ratio. So you saw that we took a look at earnings per share and dividends per share. Well, the price to earnings ratio brings that earnings back to the price. It relates the earnings back to the price. It's actually a very simple formula that we'll deal with later on in detail, and it's in the stock worksheet number 2. You take the price and you divide it by the earnings. Okay, that's simple enough. If we had a $20 stock, $2 of earnings, we would take $20 divided by 2, and that would give us a price to earnings ratio of 10. You'll see P/E, PE. Don't put a dollar sign. Don't put a percent sign. PE is unitless because the dollars cancel. I hate that word. The dollars disappear. And we're left with a 10 price to earnings ratio. Traditionally, stocks sold in the 5 to 15 PE range. A PE of 20 was only reserved for the fastest growing stocks, but now and during manias, PEs go to the heavens. 50, 100, 1,000 or more. And folks, when that happens, you know either things had better turn out really, really well for that company, or they got a long way to go to get back in line with other companies. The parachutes had better be very, very large. And we're going to spend a great deal of time learning about PE and other valuation techniques in the next 2 chapters when we discuss fundamental analysis. But this is what we're doing. We're actually starting a little bit of fundamental analysis. So now, do worksheet number 2. Do worksheet number 2. In the face-to-face class, this is when we would stop and work on it together. And when we come back, we will take a look at different types of stocks and another very important market statistic, capitalization, which we've already kind of discussed, but now we'll define it in more detail. Are you getting an education? We sure hope so. Thank you so much for being in our class, and don't give up now. Think of how much you have learned. We are so proud of you.